This LOS is Describe Classifications of Global Fixed Income Markets. Before we jump into this LOS, we'll do a bit of an introduction to the reading. Global fixed income markets represent the largest subset of financial markets in terms of number of issuances and market capitalization. These markets bring borrowers and lenders together to allocate capital globally to its most efficient uses. Fixed income markets include not only publicly traded securities, such as commercial paper, notes, and bonds, but also non-publicly traded loans. At the end of 2010, the total amount of debt and equity outstanding was about 212 trillion globally. The global fixed income market represented approximately 75% of this total. Simply put, global debt markets are 3 times larger than global equity markets. Among the questions this reading addresses, and we're going to see in the following LOSs are, what are the key bond market sectors? How are bonds sold in primary markets and traded in secondary markets? What types of bonds are issued by governments, government-related entities, financial companies, and non-financial companies? And what additional sources of funds are available to banks? Overview of global fixed income markets. Classification of fixed income markets. Common criteria used to classify fixed income markets include the type of issuer, the bond's credit quality, maturity, currency denomination, and type of coupon, and where the bonds are issued and traded. So first we'll look at the classification by type of issuer, and we can see that there are 3 bond market sectors. 1, the government and government-related sector. 2, the corporate sector. And 3, the structured finance sector. Continuing with the classification of fixed income markets, we'll now look at classification by credit quality. Ratings of Baa3 or above by Moody's Investor Service, or BBB- or above by Standard & Poor's, S&P, and Fitch ratings are considered investment grade. In contrast, ratings below these levels are referred to as non-investment grade, high yield, speculative, or junk. And don't worry, we'll be looking at this classification by credit quality again in a later LOS, but this is just the first introduction to it. Next, in terms of classification of fixed income markets, we're going to look at classification by maturity, and this is important. Securities that are issued with a maturity at issuance, original maturity, ranging from overnight to 1 year are money market securities. So overnight to 1 year are money market securities. In contrast, capital market securities are securities that are issued with an original maturity longer than 1 year. And finally, we're going to look at, on this slide, classification by currency denomination. Approximately 79% of international bonds are denominated in either euros or in US dollars. A quick practice question to check our understanding, and it should be an easy one. A fixed income security issued with a maturity at issuance of 9 months is most likely classified as A, capital market security, B, money market security, or C, securitized debt instrument. Okay, B is correct. Money market securities are issued with a maturity at issuance, original maturity, ranging from overnight to 1 year. A is incorrect because capital market securities are issued with an original maturity longer than 1 year. And C is incorrect because securitization, which leads to the creation of securitized debt instruments, does not relate to a bond's maturity, but to the process that transforms private transactions between borrowers and lenders into securities traded in public markets. Now we're going to look at classification of bonds by type of coupon. Another way of classifying fixed income markets is by type of coupon. Some bonds pay a fixed rate of interest. Others, called floating rate bonds, floating rate notes, or floaters, pay a rate of interest that adjusts to market interest rates at regular short-term intervals, for example, quarterly. So what we're going to look at first is the demand and supply of fixed rate versus floating rate debt. In an effort to limit the volatility of their net worth resulting from interest rate risk, banks that issue floating rate debt often prefer to make floating rate loans and invest in floating rate bonds or in other adjustable rate assets. Continuing with the classification by type of coupon, we're now going to look at reference rates. The London Interbank Offered Rate, LIBOR, is the reference rate for many floating rate bonds, in particular those issued in the Eurobond market. For example, a typical coupon rate for a floater denominated in British sterling that pays coupon semi-annually is the sterling 6-month LIBOR plus a spread. LIBOR is a collective name for multiple rates. LIBOR rates reflect the rates at which a panel of banks believe they could borrow unsecured funds from other banks in the London interbank money market for different currencies and different borrowing periods ranging from overnight to 1 year. The interbank money market or interbank market is the market of loans and deposits between banks for maturities up to 1 year. So let's do a practice question to check our understanding. A company issues floating rate bonds. The coupon rate is expressed as the 3-month LIBOR plus a spread. The coupon payments are most likely to increase as A, LIBOR increases, B, the spread increases, or C, the company's credit quality decreases. Well, I like this question because it really makes you think, because the coupon equals the LIBOR plus a spread. And so they're saying, you know, what's going to make that coupon increase? And A is that the LIBOR is increasing. Well, that makes sense. And that the spread, B is that the spread is increasing. So this is one that it's just one of these factoids that you got to know. So A is correct. The coupon payments of a floating rate bond that is tied to the 3-month LIBOR will reset every 3 months based on changes in LIBOR. So that's the key point to know. Thus, as LIBOR increases, so will the coupon payments. So A is correct. Why is B wrong? It says B is incorrect because the spread on a floating rate bond is typically constant. It is set when the bond is issued and does not change afterwards. So that's the key point. C is incorrect because the issuer's credit quality affects the spread, and thus the coupon rate that serves as the basis for the calculation of the coupon payments, but only when the spread is set, that is at issuance, okay? So a very nice little practice question. Okay, now we're going to look at classification by geography. So you can see this is the table from the text. Here we've got the country, and here we've got all issuers, but then it's broken up into government, financial, and non-financial. So what catches our eye first is that the US is the biggest issuer. We have a global weight of 40%. So this is very similar to what we've seen in the equity markets back in the LOS and the reading for the equities, that the US is the biggest market for equities. It's also the biggest market for debt. And we can see that government makes up 39% of the bond issuances, financial 44%, so larger than government, and non-financial is 17%. Interestingly enough, the second country is Japan, followed by the United Kingdom, Germany, etc. Okay? Not a lot to see on this slide other than the fact that the US is the largest and perhaps that the financial sector is a bigger issuer of debt than the government. And we'll finish this LOS with one last quick practice question. In most countries, the bond market sector with the smallest amount of bonds outstanding is most likely the A, government sector, B, the financial corporate sector, or C, the non-financial corporate sector. Okay, I put that table in at the end with regards to the classification by geography, and it had the sectors, government, financial, and non-financial, and it just shows you the nitty-gritty on the CFA exam. You have to pick up some of the little factoids. I call them factoids. These are just small factoids that you have to be familiar with. It's not difficult, but you get a question like this, it should be easy, okay? It's just straight out some memorization of facts from the text. So in most countries, the bond market sector with the smallest amount of bonds outstanding is most likely the non-financial corporate sector. So C is correct. In most countries, the largest issuer bonds are the national and local governments, as well as financial institutions. Thus, the bond market sector with the smallest amount of bonds outstanding is the non-financial corporate sector. And that's the last slide for this LOS. Thank you.